Right now, central banks hold roughly one-fifth of all the gold ever mined in human history. Think about that for a second. That is not a small amount. That is thousands upon thousands of tons, locked away in vaults, controlled by governments, and treated as a core pillar of global financial power. And what matters even more is this: they are still buying. Before we move forward, make sure to subscribe to the channel and like the video. Now let's begin. In 2025 alone, central banks added approximately 863 tons of gold to their reserves. Yes, slightly lower than the previous year, but still far above the historical average of around 473 tons per year seen between 2010 and 2021. And in the final quarter of 2025, buying actually accelerated again, with around 230 tons added in just 3 months. That tells you something very important. This is not slowing down, this is continuing. And as we entered 2026, the trend didn't disappear. January started slower, around 5 tons net, but February rebounded strongly to about 27 tons of net purchases, led by countries like Poland, Kazakhstan, and emerging market buyers. Even more interesting, despite gold trading near elevated price levels, central banks are still accumulating. They are not waiting for dips. They are not trying to time the market. They are buying with a completely different mindset. Now here's the big question. Why? Why are governments around the world, from Europe to Asia to emerging economies, steadily increasing their gold reserves at a time when prices are already high? Because this is not just about profit, this is about protection. One of the biggest drivers behind this trend is something called de-dollarization. For decades, the global financial system has been dominated by the US dollar. Countries have relied heavily on dollar-based assets, especially US Treasury bonds, to store their wealth. But recent global events changed that perception. When Russian foreign reserves were frozen in 2022, it sent a shockwave through the global financial system. It showed that assets held in foreign currencies, even at the central bank level, are not always fully secure. They can be restricted. They can be frozen. And that realization forced many countries to rethink their strategy. So what do you do when you want an asset that cannot be controlled by another country? You turn to gold. Physical gold held within your own borders has no counterparty risk. It doesn't depend on another government. Let's get into the real power layer of this story. Who is actually buying, and how much? Because once you see the numbers, it cannot be digitally frozen, and it remains one of the most trusted forms of value in the world. That's why gold is increasingly being treated as a geopolitical hedge, not just a financial asset. And this shift is backed by data. Surveys show that nearly 95% of central banks expect global gold reserves to continue rising in the coming years. That is an overwhelming consensus. And when central banks, the institutions that manage entire national economies, are aligned at that level, it signals something much bigger than a short-term trend. Now add another layer: inflation, currency instability, rising global debt. Unlike fiat currencies, gold has no liability attached to it. No central bank can print it. No policy decision can dilute it overnight. It simply holds value. And in a world where economic uncertainty is increasing, that matters more than ever. But perhaps the most important point is this: central banks are not reacting to the present. They are preparing for the future. Countries like Poland are aggressively building gold reserves not just for financial diversification, but for national security positioning. Emerging economies are increasing their gold holdings to reduce dependence on the dollar. And major players like China continue to steadily add gold as part of a long-term strategic shift. This is not random, this is coordinated. And once you understand that, you realize something very important. Gold is no longer just a commodity. It is becoming a cornerstone of global financial strategy again. Now keep this in mind before we move forward. Central banks are buying gold at historically high levels, even when prices are elevated. That tells you everything you need to know. They are not chasing price. They are securing position. The biggest gold buyers in 2025. At the top of the list, you have Poland. Poland added over 100 tons of gold in 2025, making it the largest buyer for the second year in a row. Its total reserves are now estimated around 550 to 570 tons, and gold now makes up a significant share of its national reserves. And here's the key part. Poland is not stopping. It has openly signaled a long-term target of up to 700 tons. That's not tactical buying, that's strategic accumulation. Next, we move to Central Asia. Kazakhstan added around 57 tons. This is part of a broader trend where resource-rich and emerging economies are increasing their gold exposure, not decreasing it. Then comes Brazil. After years of being relatively quiet, Brazil came back into the market in a big way, adding around 43 tons. That tells you something important. Even countries that paused earlier are now returning to gold. Azerbaijan is another major player. It added roughly 38 tons, continuing its steady accumulation strategy. And then we have Turkey. Turkey added around 27 tons during the year, even though it later made some sales. But here's the key point. Those sales were not a shift away from gold. They were liquidity-driven decisions, often used to stabilize currency or manage domestic pressures. Even recent reports show that when central banks sell gold, it's usually because they need cash temporarily, not because they've lost confidence in gold. Now let's talk about one of the most important players in the world, China. Officially, China added around 27 tons in 2025. But here's where it gets interesting. China has been on a multi-month buying streak, continuing into 2026. In fact, recent data shows China has now extended its gold buying to over 17 consecutive months. And many analysts believe actual purchases may be higher than officially reported. The hidden story, unreported buying. This is something most people don't realize. A large portion of central bank gold buying is not immediately reported. In fact, estimates suggest that a significant share, sometimes over 50% of total buying, can be opaque or delayed. That means what we see in official data may only be part of the story. What about sellers? Now here's another important point. Selling has been very limited. Only a few countries reduced their gold holdings in 2025. Singapore sold around 15 tons. Russia sold around 6 tons. A few smaller reductions elsewhere. And even in 2026, some selling continues, particularly from countries like Turkey or Russia. But again, this is not a trend shift. This is tactical. These countries are using gold when needed, which actually proves its value. Because gold is one of the few assets that can be liquidated quickly in times of stress. Here's what you need to understand before we move forward. Central bank gold buying is not concentrated in one region. It's global. From Europe to Asia to emerging markets. Countries are steadily increasing their gold reserves. And even when some sell, they don't exit gold. They come back. Which tells you one critical thing. Gold is not just being traded, it is being accumulated. So far, we've looked at the big picture and the major players in 2025. But to really understand where this trend is heading, we need to zoom in on what's happening right now in 2026. Because this is where the story becomes more nuanced, and honestly, more interesting. Let's start with the numbers. At the beginning of 2026, central bank gold buying slowed down. January came in relatively quiet, with net purchases of roughly 5 tons. At first glance, that might look like a cooling trend, but that's not the full picture, because just 1 month later, February rebounded sharply, with around 27 tons of net buying. That's a strong recovery, and more importantly, it shows that demand is still there, just moving in waves. Now let's break down who's behind this latest activity. Poland continues to lead. It added another 20 tons in February alone, reinforcing its position as one of the most aggressive buyers in the world right now. This is not slowing down. This is a continuation of a long-term strategy. Then we have Uzbekistan and Kazakhstan, each adding around 8 tons. These countries may not always dominate headlines, but they are incredibly important in this story, because they consistently maintain high gold allocations relative to their total reserves. In some cases, gold makes up a very large portion of their national holdings, far higher than many developed economies. That tells you something important. For these countries, gold is not optional, it's foundational. Now here's where things start to shift. We're seeing new and returning buyers entering the market. Countries like the Czech Republic and Malaysia are stepping in, each adding smaller amounts, around 2 tons. On the surface, these numbers might seem small, but that's not the point. The significance is in the participation. More countries are joining the trend, and when participation expands, it strengthens the entire structure of demand. We're also seeing growing interest from regions that were previously less active. Parts of Southeast Asia, and even some countries in Africa, are beginning to increase their gold exposure. This is how a trend evolves. It starts with a few major players, then it spreads, and eventually it becomes global. What about selling in 2026? Now, just like in 2025, there are still some sellers. Turkey reduced around 8 tons. Russia trimmed about 6 tons. But again, context matters. These are not long-term exits. These are short-term adjustments, often driven by currency stabilization or liquidity needs. Think of it like this. Gold is the asset central banks sell when they need support, but it's also the asset they rebuild when conditions stabilize. That cycle is very important because it shows gold's dual role: store of value and emergency liquidity. Year-to-date 2026 trend. So where does this leave us overall? In the early months of 2026, total net buying is sitting around 30 tons. Yes, slower than the aggressive pace of 2025, but still clearly positive, still steady, and still consistent with long-term accumulation. And here's the key forward-looking insight. Expectations for 2026 suggest total central bank demand could reach around 850 tons by the end of the year. That's not a slowdown. That's continuation at historically elevated levels. The real shift happening. Now here's the most important takeaway from this section. The story is no longer just about how much gold is being bought. It's about who is buying and how widespread it's becoming. We are moving from a concentrated trend to a distributed one. More countries, more regions, more participation. And that makes the demand base stronger, not weaker. Because when demand is spread across many players, it becomes more resilient, less dependent on any single country, and much harder to reverse. Now keep this in mind before we move forward. Even with price fluctuations, even with short-term selling, central banks are still net buyers, and the list of buyers is growing. That is a powerful signal, because it tells you this is not just a phase. This is a structural shift in global reserves. Now that we've seen who is buying gold, let's step back and look at something even more important. Who already controls the world's gold? Because this is where global financial power becomes very clear. We're talking about thousands of tons of gold, accumulated over decades, sitting inside national vaults. And the countries at the top of this list are not there by accident. Let's start with number 1, the United States. The US holds approximately 8,133 tons of gold. That's by far the largest reserve in the world. And it represents a massive foundation of financial strength, even today. Despite all the talk of digital assets and modern finance, gold is still sitting at the core of the system. Next comes Germany. With around 3,350 tons, Germany holds the second largest gold reserves globally. This reflects decades of accumulation and a strong cultural and financial emphasis on stability. Then we have Italy and France. Italy holds roughly 2,450 tons. France is close behind at around 2,430 tons. These are legacy reserves, built over time, but still extremely relevant today. Now let's shift to a country that has been in focus throughout this entire video: Russia. Russia holds around 2,300 tons of gold, and over the past decade, it has significantly increased its reserves as part of a broader move away from dollar-based assets. And then we have China. Officially, China holds just over 2,300 tons of gold. But here's the key detail. Gold makes up only about 9% of China's total reserves. That's relatively low compared to Western economies, which suggests something very important. China still has room to increase its gold holdings significantly, if it chooses to. And given its consistent buying trend, that possibility cannot be ignored. Now let's bring in other major players. India holds around 880 tons. Japan sits close to 850 tons. And then comes one of the fastest climbers in recent years, Poland. With approximately 550 to 570 tons, Poland has rapidly moved up the rankings. And remember, it's still actively buying. There are also countries like Switzerland with around 1,040 tons, and Turkey with 600 plus tons when including treasury holdings, each with their own strategic approach to gold. What does this data really show? Now here's where it gets interesting. At first glance, it may look like developed Western countries dominate gold reserves, and historically, that's true. But the trend is changing. Emerging markets are increasing their share. Countries like China, India, Poland, and others are steadily climbing. And in some cases, gold now makes up 17 to over 20% of total reserves. That's a significant allocation. Even more striking, some countries hold extremely high percentages of their reserves in gold. For example, nations like Uzbekistan maintain very high gold ratios, in some cases approaching the majority of their reserves. That's not diversification, that's commitment. And here's the global perspective. Central banks collectively hold around 20% of all the gold ever mined. Think about that. 1 out of every 5 ounces of gold in existence is controlled by central banks. That is enormous influence. The power shift. Now let's connect everything. This isn't just about numbers, it's about direction. The countries that already hold large reserves are maintaining them. But the countries that are increasing their reserves are mostly outside the traditional Western system. And that suggests something deeper. A gradual shift in financial power. A move toward diversification. And potentially, a more multipolar monetary system in the future. Now here's the key takeaway before we move forward. Gold reserves are not just historical leftovers. They are active strategic assets. And the countries increasing their gold today are positioning themselves for tomorrow. Now that we've seen the data, the rankings, and the global trends, let's bring this down to real-world strategy. Because behind every number, there's a story. And those stories tell us exactly where the world might be heading. Let's start with Poland. Poland is not just buying gold randomly. It sits in a region that has experienced geopolitical tension firsthand. And its aggressive gold accumulation is not just about returns, it's about security. By targeting up to 700 tons of gold reserves, Poland is building a financial shield, something tangible, independent, and resilient. Now look at China. China's approach is different. It's not loud. It's not aggressive in headlines, but it's consistent. Month after month, it has been adding gold, quietly increasing its reserves while keeping a relatively low percentage of gold compared to its total assets. That tells you something important. China is playing the long game. Gradual accumulation, strategic diversification, reducing reliance on the US dollar without disrupting the system too quickly. Then we have India and the broader BRICS group. These economies are increasingly focused on reducing dependence on dollar-based systems. Gold plays a key role here. It's neutral, it's globally accepted, and it allows countries to diversify without tying themselves to another nation's currency. Now let's talk about Turkey and Russia. Both countries have shown that gold is not just a reserve asset, it's also a tool. At times they've sold gold, not because they lost confidence in it, but because they needed liquidity to stabilize currencies, to manage economic pressure, and then they return to buying. That cycle tells you something powerful. Gold is not just a store of value, it's a financial lifeline. And then there are smaller but extremely important players. Countries like Uzbekistan, Kazakhstan, and others. These nations hold a very high percentage of their reserves in gold. In some cases, the majority. Which means their confidence in gold is not partial, it's fundamental. What happens next? Now let's step into the future, because this is where everything comes together. Central bank demand for gold is expected to remain strong, potentially reaching around 850 tons again in 2026, even at elevated prices, even with short-term fluctuations. That tells you one thing very clearly. This is structural demand, not speculative demand. And here's why that matters. Because structural demand is what drives long-term price trends, not hype, not short-term trading, but consistent large-scale accumulation. Now, does that mean gold will only go up? Not necessarily. There will be volatility. There will be periods where central banks slow down. There will be moments where some countries sell to manage liquidity. But the foundation is being built, and it's being built quietly. Final takeaway. So here's the big picture. Central banks around the world are reducing reliance on the US dollar, preparing for geopolitical uncertainty, protecting against inflation and currency risk, and building long-term strategic reserves. And at the center of all of that is gold. Now think about this. If the institutions that manage entire economies are increasing their exposure to gold at this scale, what does that signal to individual investors? That's the question you should be asking. If you found this breakdown valuable and want more deep insights into gold, silver, and global markets, make sure to subscribe to Gold and Silver Updates and stay ahead of the trends that matter. Because in today's world, the biggest moves don't happen loudly. They happen quietly. And by the time everyone notices, it's already too late.